Welcome, everybody, to Multifamily University. We are here. It's September of 2022. And you know what that means. Tick tock, almost the end of the year. And many of you are probably looking at what you've earned this year and hopefully thinking, wow, this has been a great year. And many of you are saying, what the heck am I going to do? I'm in a pickle. Well, we're here to help you with that pickle and talk about cost segregation and bonus depreciation strategies. With me is David. I'm sorry, I might not say his last name right.
Deshotels. It's a good
Deshotels.
Cajun French name.
David, it's a beautiful name, David Deshotels. And I'm very excited. So I'm going to turn it over to David. But before I do, I want to let you all know, because this question always comes up, this is being recorded. You will get a replay of this in your email in the morning. Or actually probably later in the afternoon. Secondly, feel free to ask questions in the Q&A box, and we will be answering those questions at the end. If something's going on, something's going wrong, you can't hear, etc., that's what the chat box is for. Questions are for the Q&A box. And with that, I'm going to hand over to David.
Anna, thanks so much. I usually kick off my webinars and the seminars that I do around the country with a quote from Jack Welch. The operative assumption today is that someone somewhere has a better idea. And the operative compulsion is to find that idea, learn it, and put it into action fast. So what I want to do today after business hours, let's just relax a little bit. But what I want to show you is some better ideas in increasing your cash flow by using the tax codes that are available to you to accelerate depreciation or accelerate expensing. Now, we've talked about cost segregation here, and we'll talk about cost segregation, but my intention is not to make this a cost segregation commercial, but to try and show that that's the basis of a number of tax codes that if you do a cost segregation study, it unlocks the door to a whole host of depreciation deductions, accelerated expensing that you might not be aware of. I train CPAs across the country, and a lot of them are not aware of that. So let's share some better ideas and just kind of have a strategic discussion on what's appropriate in accelerating depreciation. I want to thank Eric Blue for inviting me here. We met at a real estate conference in Chicago. Both Mark Gross and myself were there hosting a panel and giving a presentation. And he said, why don't you come do that for my people? They need to hear this. Here we are. It's a pleasure to be here. What I hear often is bonus depreciation is going away. Oh my gosh, the sky's falling. We're not going to get it. It's going away. No, it's not. It's going to be reduced. Next year, it's reduced by 20%, but actually you'll still get deductions above the 80% mark. And I'll show you how to do that with cost segregation. So just the overview, the big picture, it's just a tax saving tool. It's a methodology. It's complicated. We're going to go into this, show you a little bit about what cost segregation is, because there's a few people on here that don't know what cost segregation is, but I'll try and, get through that and be able to share, some real insights into the tax code that you may be missing. I can't make you a tax hero all in one day. I can't make you a deduction expert all in one day. But if I can simply raise your awareness to say, hey, I've got that in my situation. Hey, we did a repair like that and we capitalized it. We could have expensed it. Or, hey, I'm going to own real estate at some point in time. And I want you to understand, here's the opportunities for you to accelerate depreciation so that you have more cash flow. Because in this inflationary time, it's all about cash flow. These are not tax loopholes. But it is a sophisticated way to bring the tax code, the four corners of the tax code together in a strategy that creates a better idea. So Anna, I want to talk about better ideas for a moment with you, if you would join me here and open up your mic.
Absolutely.
Great. So the good thing about ideas is that if I give you $1 and you give me $1, we each have $1. But if I give you an idea and you give me an idea, we have two ideas, right?
That is true.
The bad thing about ideas is what you already know prohibits you from learning new things. Let me say it again. What you already know prohibits you from learning new things. Anna, can I get you to help me with this?
Sure can.
On the next slide, I'm going to put it up. It's going to have 7 little words that any third grader from the Louisiana public school system can read. That way you know they're easy words. I'm going to show you these 7 little words. I'll show you the slide, and then I'll ask you what you saw. I'll show it to you for about 4 seconds. Ready?
Okay.
Well, let's see. And so the slide freezes just when I needed to. Okay. So what did you see?
I love Paris in the springtime.
Oh my gosh, you got it. I put it up. Fantastic. So what the majority of people saw was I love Paris in the springtime. So if you're in the chat and you saw I love Paris in the springtime, that's what the majority of people saw. So you're one of like 40 people that I've shown this to out of the thousands that got it the first time. But for those that saw I love Paris in the springtime, you only saw 6 words. Well, what happened was your eyes saw it. It went to your subconscious brain that says, I've been taught since the 3rd grade that doesn't make sense. And then it sent to your conscious brain, and that's what you, and it says, I love Paris in the springtime. But Anna, you did great. I love Paris in the
It's all in the details,
springtime.
David. It's all in the details.
It is. So you're a detailed person. So you caught that.
I am a detail person. Also very visual.
You are like the 44th person to catch that the first time out of the thousands that I've sent that to. So if you didn't see this the first time, that's okay, because most people don't. Okay, and Anna, thank you so much. I'm going to get someone that's not as astute like you are to host the next seminar. Okay, 12 months ago, we were worried about taxes. We were going to tax the rich, spare the poor. No one really saw inflation coming. Now we have skimpflation, where boxes are smaller. The rolls in our toilet paper are bigger, so they can put 20 less sheets. I think it is. Charmin has 20 fewer sheets in their on a roll of toilet paper. 70 less raisins. Frito-Lay's jipping us out of 5. It's skimpflation. They're trying to give us smaller packages for the same price. Inflation is going up. So what's that mean to us in the real estate community? They're going to kill us. They're going to kill us, I'm telling you. They're raising the interest rates like crazy. No one saw 12 months ago that the Fed was going to be raising these rates. And we still have a few more that are coming, right? So what happens? Some real estate deals don't pencil anymore. You've got to dig deep. You've got to be with people that can look and find those hidden gems, right, Anna? Find those hidden gems that says, this is still a good deal. This one works. Here's where you invest it. So real estate's getting harder if you want to make money because of the interest rates that are going up. So what's that mean to the people that own buildings? Well, cash flow is going down. It's more expensive to manage your building. That's why I'm telling people, cash flow is king. $1 today is worth more than $1 tomorrow. So get your cost segregation studies done. Do the study to generate cash flow and get those dollars today versus waiting for those cost segregation studies in the future where those deductions will not be worth as much. Okay. So again, $1 today is worth more. So what I want to try and do is show you how to get more cash flow out of your building by using these accelerated depreciation strategies. Okay. You don't need to know all these codes. That's my job. But you do need to see that cost segregation is the tax code where all of these other regulations sit firmly on that. They stack on top of cost segregation. Without doing a cost segregation study, you might not be able to fully take advantage of these other deductions. So I want to show you what those are and give you a little bit of a training on cost segregation. You have a choice when you're depreciating your building. You can look at it as a whole, or you can look at it in its parts and pieces. Straight line depreciation looks at the building in its whole. It's very easy. You get the same deduction for the next 39 years or for the next 27 and a half years on multifamily. Cost segregation looks at the parts and pieces of this building to be able to say, here's all the parts and pieces that have accelerated depreciation and are eligible for bonus depreciation. Therefore, I get my deductions up front versus having to wait for those for 27 and a half years. What's that mean? It acts like an interest-free loan from the government where you get the deductions up front and you hang on to those. So for $2 million worth of building, it means about $100,000 in cash flow. Depends on what type building, but that's just a rule of thumb. That's a lot. That's a lot of money. $2 million doesn't buy what it used to. But if you can get $100,000 in cash flow from the deductions that you can get out of cost segregation by choosing the right methodology, that's huge. Okay, so all right, and I'm going to put you to the test again. So I usually use the Big Mac analogy to describe straight line methodology. If I'm going to describe a Big Mac, straight line methodology, I would describe it as a hamburger. But if I were to use cost segregation methodology and language to describe it, what would I call it?
Let's see, we would call it a taco.
You're probably not old enough to remember this, but when we were kids growing up, everyone knew the McDonald's jingle of 2 all beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun. So
yeah, see, and I'm not mom that never took my kids to McDonald's. So
okay, so parts and pieces, identifying the parts and pieces of the building, we can accelerate those. And we look at that building and we go in and we identify, again, all the parts and pieces and put them in different buckets. We'll put them in 5-year buckets, 15-year buckets. So what is that? So a cost segregation specialist is going to go in, take lots of pictures and start adding up from their plans all of the crown molding or how many square feet of flooring, carpeting, or linoleum that they have, and place it in a bucket on a report that allows the CPA, the tax pro, to be able to accelerate the depreciation on this, to take the depreciation over 5 years for the personal property or over 15 years for the land improvements. And you can see those things that go into the bucket. Land improvements are your parking lots and signs and light poles and everything on the outside of the building. 5-year property, moldings, carpeting, specialty plumbing, and so forth. 15-year property QIP is when you have a building and you renovate it and you do work on the inside. A lot of that work is eligible for QI, qualified improvement property, 15-year property, and is eligible for bonus depreciation. So I say all that to say, a cost segregation specialist is going to identify the parts and pieces and put them into a report that they give to your tax professional. And then your tax professional will be able to file for those deductions and get those using bonus depreciation all in the first year. So 5 to 15-year property is all eligible for depreciation under bonus depreciation, 100% bonus depreciation in the first year. We'll also give you all these parts and pieces as well, all the structural parts and pieces, and I'll explain why that might be important to you coming up a little bit later. So again, as we know, bonus next year is going down to 80%. Year after that, 60%. So it's starting to go away. But if you've built in 2022, you're still eligible for the 100% bonus depreciation. And I won't go into this too much here, but I did want to share this with you, this chart, to show you the difference of what that means. The light blue line is straight line depreciation. You can see how it got its name. You get the same deduction every year for the next 27 and a half years or 39 years. Accelerated depreciation, you can see the red line. In the first 5 years, you get a bunch of these deductions because your 5 and 15-year property that your cost segregation specialist has identified, you're able to write that off in the first year. With bonus depreciation, though, in the green line, you can take all of that in the first year if you can use it all. So you can see how bonus depreciation helps front load the depreciation deductions that you're going to get over time. You can see that, over time, if you take bonus and get a lot in first year, you can see that subsequent years, you still get depreciation. You just get a little bit less than you would under straight line depreciation. So when's the best time to implement this strategy? when you've bought a property, newly constructed property, before or after renovations or additions. Um, Property purchased in the past, you can still do cost segregation on it. So if you've bought a building in the last 10 years, cost segregation still might be a strategy that works for you. Let me go through a couple other slides, Anna, and I'm going to turn it over to you for your message. But
Sounds good.
what happens if you can't utilize all the depreciation? You can carry it forward. Does not expire. No limit on time. What bonus will create a huge amount of deductions, and you're a passive investor, you are somewhat restricted in what you can utilize. As a passive investor, you can utilize these deductions to offset your passive income. That means the rent that you might be getting from your building. And that's it. But one of the things that you need to understand is if you own multiple buildings, you can utilize those excess deductions against those passive incomes from other buildings. So if you do a cost segregation on one building and have more deductions than you can use, if you have additional properties, you can apply those deductions against those incomes as well to reduce your tax bill. Can you choose not to use bonus depreciation? Yes, you don't have to use it. You would have to opt out of it, but it's not necessary that you use it. Or could you use it on some things and not others? What we find is a lot of people will use it on their 15-year property because there's usually less 15-year properties. So they'll take that and it takes longer to get it. So, hey, I'll take those up front and then I'll wait and get my 5-year property over the next 5 years. And so bonus depreciation is going to 80% next year, but understand that you're still going to get something above that 80%. In that if you use bonus depreciation and take 80% of what you're eligible for, there's still 20% left there. Well, you get to take part of that 20% that's remaining. On 5-year property, take that 20% divided by 5 years, and you actually get 2 of those years in the first year. So even though we're going down to 80%, it's actually more depreciation than just the 80% in the bonus. What does not qualify for bonus? Well, if you put something in service and take it out of service in the same year, that does not qualify. Inherited property, property converted to business use and then to personal use in the same year, or property used less than 50% in bonus, that doesn't qualify either. So these are all things that you need to be aware of. Interior renovations. If you have a non-residential structure, you are probably eligible for qualified improvement property. Anything that you do to the interior of that building, you can write off because it will have 15-year property. You're eligible to write that off because that's 20 years or less is eligible for bonus depreciation. So in 2023, that will be 80%. But know that if you buy a property, needs to be renovated, and you do a lot of work on the inside, just about all of that you can write off in the first year. 80% in 2023. And for the lawyer, I just threw this in just to show you that there's a bunch of other things that, prohibit you from using bonus, like marijuana grow facilities. Can't use bonus. Who would have known? So again, our job is to put things in different buckets, increase your cash flow, and I'll show you how that helps. Here's some results on cost segregation, just to kind of show people that the kind of numbers that you're looking at. An apartment complex, just under $1 million, $82,000 of cash flow by doing that, just by buying the property, choosing the right depreciation method, and getting the bonus depreciation use out of that. Some self-storage. I seems like I saw a self-storage unit in your property. They do extremely well on cost segregation, but on apartment complexes, especially the ones that you were talking about, that is huge, because the picture that you showed, that before and after picture, I want to make people aware that you probably need a depreciation specialist for this strategy. But if you're going to buy an apartment complex and then start renovating the units, you want to capture what's in that unit up front. Because when you rip that out and you throw it away, those materials have value on the depreciation schedule that needs to come off. That's a tax deduction for you. So everything that comes into the dumpsters is a tax deduction. So you want a cost segregation specialist to go in, look at that, take lots of pictures and value what's there as it is today. And then when you put the new stuff back in, then you're able to cost seg that again and take bonus depreciation on that. So the value add strategy of ripping and renovating, where you can write off the labor, write off what you're taking out, and then cost seg, appropriately identify those parts and pieces that are eligible for accelerated depreciation. You can write those off as well under bonus depreciation. 100% in this year, 80% next year, 80% plus. But it's still, even though it's 80%, it makes sense. So again, we had talked about if you're in these deals and what's the difference between passive and active? So I don't want to oversell cost segregation. I want to try and show you that if you are a passive investor, you're going to be able to write off all your income. You're going to be able to have enough deductions to be able to not have to pay any taxes on what you're getting. And you can carry that excess forward so that you might not pay any taxes for 3-4 years on what you have. So again, more cash flow for you. What do we need in a recession? Cash flow. The strategy still works. Now, is it better to be active income? Yes, because you're no longer on the passive loss rules. You can therefore apply that to any W-2 income that you might have or other projects. Again, passive income, if you can't utilize it all on the project that's has cost segregation, you can apply those passive losses against other passive income, other buildings that you own. So for those that own multiple buildings, it's a great strategy. It's a great it's a great blessing from Congress to be able to give us that. And again, you can carry those forward if you can't utilize those. They don't expire. You're going to be able to use those for quite some time. You might say, well, how do I become active? Well, you have to have an IRS real estate professional designation. Okay, what's that mean? I urge you to Google that. There's 4 or 5 different criteria. One is you participate 750 hours a year in some form or fashion in the real estate industry. That's about 13 hours a week. So if you're just a passive investor and you have a W-2 job, there's no way that you're going to be able to put in 750 hours or 500 hours, or that you materially participate in running the property. Here's my warning to everyone. If you're not an IRS real estate professional and you can't meet these criteria, don't try and fake it, because they're watching that closely. And they got about a 300-to-1 win record for people that they've challenged and said, we don't think you are one. And, they didn't make it. The most important thing, if you are, is document your daily activities. Keep a daily log, handwrite it. One of the court cases, they say, Mr. Jones, we see in your handwritten log here, you use the same pen the whole year. How did you do that? It's the same pen. It's like, well, you sat down at the end of the year and you recreated all this, didn't you? Like, yeah, he lost the case. So they're really looking at this very hard. Oh, I'll make my wife a real estate professional. Be sure that she can make these material participation criteria, that she can put in the hours. Don't try and fake it, because that's something that they're looking at. David, you're going to create all this accelerated depreciation. What happens when I sell my building? Is there going to be recapture? Yes, there will be recapture. Have an exit strategy. Have a 1031 strategy where you roll that capital gains and these depreciation savings into the next building. So you can mitigate that recapture by having a plan, having better ideas. So get with a depreciation specialist, ask them, okay, what do I do? What is my exit strategy? Talk to your CPA about this, because there's ways to mitigate the recapture on this. If I do a cost segregation, can I still go into a 1031 exchange? Yes, you can. But David, they don't allow personal property, and you're identifying personal property. How's that going to work? Well, for buildings, there's an exemption. It's called incidental personal property. So if your personal property that you've identified in a cost segregation study is less than 15% of the value of the building that you're buying, well, then it all can come in and there's no restrictions. So that's something to be aware of. So don't be afraid to look at 1031 exchange opportunities. Plan ahead. Prices are coming down, but sometimes with the inflation and with the rates of what it costs to borrow money, sometimes those deals don't work. So be sure that you have something. Be sure you got one before you get into this, because it's getting longer and harder to get those deals done. Okay, so again, let me tell you, if you're, again, as Anna said, buying an apartment complex, renovating that, you want to identify, what's the value of there is there now. You probably want a depreciation strategist to help you identify what's there, value it, goes in the dumpster, you're able to write off, and what's going in, you can do a cost segregation study, identify all the parts and pieces that would be eligible for accelerated depreciation, and be able to take advantage of the bonus depreciation that comes with that. Okay, so here's a couple scenarios. You buy the multifamily complex or the shopping center, and the parking lot needs to be overlaid. Okay, so you spend the money to be able to do that. How do you treat that? How's your tax professional going to treat that? If your tax professional knows what he's doing, he's going to be able to write that off in the first year as an expense, to say, that's a repair. That's not an improvement, that's a repair. And repairs are eligible for accelerated depreciation, or, they're eligible to be able to expense that. Part of that is you need to know what's the value of the parking lot that's there. Cost segregation specialists will tell you the value. And then what did I spend on the overlay? More than likely, it's what you spent was less than 35% of what the original parking lot was worth. That's one of the criteria that we use to know whether you can write that off or not. Your tax pro may or may not be aware of that. So if you're doing an asphalt overlay, check with a depreciation specialist, get some help, make sure that you're able to write that off and not capitalizing that and taking that for the next 15 years. Now, if you capitalized it, you can write it off under bonus depreciation. But the difference is there's no recapture if you call that expense. There will be recapture if you call it 15-year property. Makes a big difference at the time of sale. So these are just some strategies that you need to be aware of. How about I've got a warehouse with HVAC rooftop units, and one of them was busted. I got 5 of them. One of them went broke. We had to replace it. What do I do with that? Your CPA might say, "Wow, those 25,000. We gotta capitalize that. That's a big number." No, if you know how to use the regulations, you can say that's less than 35% of all of my HVAC rooftop units. Therefore, it's a repair. Therefore, I can expense it under the tangible property regulations. I'm not expecting you to remember any of this stuff. You'll just need to remember my phone number at the end of this, and I'll help you through these. Just call me. I'll help you and your tax pro make sure that you're getting the deductions you deserve. How about replacing a roof? Expensive to replace a roof. A lot of CPAs or tax professionals are still capitalizing these. So if you put on a membrane roof or shingles on your apartment complex, you can more than likely write that off as a repair and take that as an expense. You don't need to capitalize that. Not having a capitalization specialist, a depreciation specialist, may be costing you money. Be sure that you partner with someone or have someone in your inner circle that can help you understand all these things, that when you remove the old roof, you might be able to write those down and depreciate the new one, or you can keep depreciating the old one and then expense the new one. So, for some of you out there, this is worth tens of thousands of dollars of cash flow this year that, I don't want you to lose that. I don't want you to lose out on, some of these items that you're eligible for. Okay, so we talked about apartment complexes, a residential. How about a non-residential? You buy the property and you're going to do a bunch of renovations on the inside. First, you're throwing stuff away, write that off, have have that valued and write it off. Labor to remove it, write that off. And what you're putting in may be eligible in the interior, may be eligible for what's called qualified improvement property. Your tax professional is going to know that term, but it may be eligible for qualified improvement property where you can bonus depreciate all of that in the first year. That's huge, huge amount of cash flow. So you do a $100,000 renovation on the inside, you very well may get, 300, or excuse me, 30,000 and 37,000 back on that $100,000 reservation, just by knowing all these parts of the tax code, just by having a depreciation specialist help you through that. So have I said that enough that you need a depreciation specialist? Okay, I won't say it again. Again, qualified improvement property. This is on when you've owned the building at least one day, or someone before you owned it one day. You can write off the interior renovations that you're putting in there. So keep lots of records. Probably best to have someone document. Take lots of pictures of what's going in. Include that in cost segregation studies so you can write that off. And it will be at 80% bonus depreciation next year, 100% this year. Again, renovations and remodels. You buy the Airbnb and you renovate the house. You want to be able to write that off. Here's one thing to be careful of. If you had one of these renovations in 2018 or 2019, the rules were different back then. And your tax professional probably said, okay, we have to capitalize that, which you had to back in 2018 or 2019. But in 2020, the CARES Act changed the regulations. So you can go back and make a change and say, I capitalized everything, but I really should have been able, now with the new regulations, to be able to write that off. If you haven't gone back to 2018 or 2019 remodels, you need to ask your tax pro, hey, let's look at this again. I understand that simply by filling out a form called a 3115, application for the change in accounting method, we can go back and be able to write this off. If that applies to you, give me a call. I'll tell you what words to use. I'll talk to your CPA, or simply send me your depreciation schedule and I'll tell you if you're eligible for that. I had one actually this week where I did that for someone. The Inflation Reduction Act wants us to make our buildings more fuel efficient, more energy efficient. There's incentives to do that. One of the incentives is to put in LED lighting. Let's look at that. If you do a LED retrofit of your building, you can probably write off 100% of that. How is that, David? How can I do that? The fixtures that are up there, you're going to change those out. Labor to pull those out, you can write off. Remaining depreciable value of the fixture, you can write that off because it went into the dumpster. The new fixture that's going in qualifies under QIP, qualified improvement property, can be written off as well. So you can write off more than 100% of the cost of the project. So $1 million project, that's going to save you $300,000 to $400,000. Not everybody knows that. We at CSSI, we do a lot of LED retrofits, and that's one of our advantages in the marketplace is we do the tax work to get that done for our clients so that I can put $400,000 of cash against that $1 million project. Don't miss those deductions. They're there for you. They're there to help you. Make sure that you're taking full advantage of all of these deductions. Okay. So again, roofs, HVAC, there's special rules for them. You can either write those off as a repair, or you can write them off under Section 179. There's lots of ways to be able to do this. Section 179, I won't go into this because, mechanical engineer talking about the tax code. I understand this isn't the sexiest things to go into, but it's sexy when you can save all the money that you can potentially save by knowing the tax code or having someone help you through this. All right, let's see here. I think, Anna, I think we probably need to wrap this up here. So time again to do a cost segregation study. It's when you purchase the property, or if you've had property for the last 10 years and have not done a cost segregation study, Now might be the time to get those deductions now because of inflation. If you do it in the future, it won't be worth as much. Or you want to make sure that you get the 100% bonus depreciation over the last 5 years. So, those are some of the trigger points in applying all of these rules and regulations that I've been talking about. So it's not your job to know all these. It's your tax professional's job to know all these. But I train thousands of tax professionals that they don't know all these. Find a good depreciation I wasn't supposed to say that, but find someone to help you keep more of your money because it's your money. So, Anna, let's take some questions from people here.
Awesome.
If that would be good.
Yes, this would be great. I'm launching a little poll. So if y'all wouldn't mind just answering those questions, and let's dive into these. So let's start with this one. I've owned a rental condo for 20 years. Is it still worthwhile to do a cost seg?
Probably not. Probably not, because you've depreciated this condo for 20 years, right? So the depreciation rate on that condo is 27 and a half. So you've only got 7.5 years left to depreciate. It's not going to pay you to pay someone like me to do a study for you to get that additional 7.5 years. So you've gotten everything that you're probably going to get. It probably is not going to be cost effective to do a cost segregation study. That's my opinion.
Can I do a cost seg on my own house after the remodel is done? Also, how about the JADU, maybe the junior ADU? I'm not quite sure what the J is. I've built in the house. Will I get bonus depreciation?
I'm not familiar with the JADU. So if you want to put that back in.
Maybe we'll just call it an ADU. Maybe we'll just call it an ADU. So first, can you cost seg your own house after the remodel is done?
No, because you haven't put it into commercial service. So if it's your house, you typically don't depreciate your house. If you put your house in service, let's say you have your house and you move out and you want to create an Airbnb, your house is on the beach, that's going to be great. Okay, so now you can start depreciating that structure from the time. So even though you've lived there a number of years, you haven't depreciated. Now the depreciation starts. So now you would apply a cost segregation study, bonus depreciation. And if it's an Airbnb rather than a long-term rental, the Airbnb gets 39-year depreciable rates. The long-term rental gets 27.5 years. But it may be active income from you. It may make you a real estate professional because you're managing the day-to-day of the Airbnb. Therefore, you can use all those deductions against not only the income that you're getting, but maybe a spouse's income or other rental properties or capital gains and so forth. So it makes you a real estate professional, which is extremely valuable. How about that?
Okay. Can cost segregation or bonus depreciation be used on a foreign investment property that is a commercial property?
Yes, if there is a building in Paris, I'd like to go there personally, so I'm going to give you the best rates possible so I can go there and inspect it. Yes, if you are paying U.S. taxes, you are eligible to do cost segregation on that building, even though it's not in the U.S., and accelerate depreciation. Again, if you're paying U.S. taxes. So yeah,
very interesting. That was a great question.
Yeah,
that was not the answer I expected, but what a good question. If all my properties are out of state and I get my real estate agent license in my state, can I claim to be a real estate professional?
That's a great question. And so you can combine activities. So if you're in the real estate game and you're, again, Google it, look it up, have your tax pro send you all the regulations. But if you're in the real estate game, if you're buying and selling or managing or redoing, or there's all kinds of ways where you qualify. And as real estate agent, yes, you would qualify, and you would combine those activities with the activities of managing your properties. Now, you said you probably have someone that manages your property for you in those other states. But being a real estate professional or real estate agent would give you a good shot at combining those to say, yeah, you've got to look over the records, you got to call, you got to make sure things are done. In addition, you don't participate materially. You're not the one doing all the work, but you can combine, your real estate broker or real estate agent activities with that. So, ask your tax pro, Google it, make sure my advice is good.
As a limited partner, when I get a Schedule K with these upfront cost segregation, what income can I use these deductions against?
So your passive income that you're getting from the project. So if you're receiving income from that project as passive income or other projects you can have, any passive income, you can put those deductions against that that income. That's passive income.
Okay, assuming one does not qualify as a real estate professional, are you able to use passive losses from rental properties against profits gains from real estate syndications?
It's I'm going to pass or sidestep that one to say talk to your tax pro about that one for your particular situation, because there's a lot of things that go into making that decision. So I apologize for sidestepping it, but I don't want Anna to have to edit this this later to go, I gave that answer off the top of my head and it wasn't exactly right. So
Okay, next question. I am assuming cost segregation works also on single family investment properties. What minimum value does it make financial sense to do a cost segregation? Great question.
Great question. Great question. It's I tell people it's like a box of diapers. It depends. It's usually usually you've heard in the industry, oh, $1 million and below, it doesn't work. Prices have come down at our shop. We've found ways to be able to do these studies cost effectively, where it might be $2,500, $3,000 to do a study on a home that might be worth $250,000. But you bought it and you put in $70,000 in the interior. So typically what you should do is talk to a cost segregation professional, say, here's the house, here's what I paid for it, here's what the land costs, so you can subtract that, here's when I put it in service, and let them run some analysis and tell you, here's what it would cost, here's the results that you might get from your purchase and from the type house it is, how big is the driveway and so forth. Let's see if we can make it work. So but to make a $250,000 property work financially, where you're paying me a closing cost to get this interest-free loan from the government, we make that work all day long.
Okay. Will slides be made available?
Yes, I'd be happy to share this.
Great. So they will go out with the replay. Can you cost seg special assessment fees on non-residential condo units?
Again, a tax question better suited for your tax professional to answer that for you. So I'll dodge that one as well.
Okay. Can a new AC unit or tile floor be depreciated in 1 year, or expensed, in other words, and be written off against rent income for the same year?
Again, it depends. So so if my first question would be, okay, you changed out an AC unit. Okay, what did you change? And how many of those AC units do you have? If you're in a building that has 5 AC units and you change out one because it quit working, well, that's what's called a repair, and you can write it off as an expense. If that's the only one that you have, then you have to call that improvement, and you have to capitalize that. Okay, so now that you have to capitalize it, can you Section 179 it? If it's in your trade or business, you can. If it's in a multifamily or residential, you can't. So it's facts and circumstances driven on what's eligible and what's not. So is it, did you replace something on the interior where it's, the blower motor up in the attic and the heating coils and so forth? Was that what was replaced? Yeah, you might be able to write that off under qualified improvement property in a non-residential building. In a residential building, you could not, because it's QIP. So sorry to give all that, but I'm trying
Yeah,
to.
it kind of gets complicated sometimes, right?
Yeah. It is complicated. So I'm kind of trying to show you the complexity of what your tax pro has to go through, and why, if you had a depreciation specialist in your phone, you can pick up the phone and ask them, okay, what do I do here? So you're more than welcome to call me with that question, and I'd be happy to give you free advice on here's what you're eligible for, because it is facts and circumstances. It depends on the facts and circumstances.
Okay,
Great question.
here's another one. I've got like a few good ones for you coming up here. So I took a 401k withdrawal this year and bought an investment condo where I did some major repairs and updates. Can I do 100% bonus depreciation for 2022 to minimize tax liability from the 401k withdrawal?
Okay, so you put your money into the property. It generated income. Can you? Is it passive income for you, or is it active income for you? More than likely, it's passive income, and you'll just be able to write off the rent that you received from that. Um, that would be my answer to a tax question there. But if it doesn't sound right, again, give me a call.
Can I do a cost seg on a rehabbed property I just sold? Bought it in 2021, sold in 2022.
Okay. So it won't make sense for you to do a cost segregation study on that, because what you're essentially doing with a cost segregation study, identifying all the parts and pieces that have accelerated depreciation. There's recapture when you sell that. So even if I went in and identified all the parts and pieces and allowed you to depreciate that, over the first year, and then you sold it in the second year, then there's recapture on that, where you're going to have to pay taxes, and the recapture rate is a little bit higher on those. So cost segregation is a time value of money, to where you want to buy the property, get that interest-free loan from the government, pay the closing cost to a cost segregation specialist, but enjoy the benefit of having that money and putting that money to work for you. If you only do it for a year, it doesn't make sense. If you did it for 2 years, 3 years, yeah, maybe it depends where you're going to put that money. Can you put it into another project where you can make a killing, or you have another investment that you would put it in? Yeah, it might make sense. But for just a year, buy it 1 year and sell it next year without having done the cost segregation study in the front, it doesn't make sense for you.
Can depreciation loss be used towards gains on stock sales?
No.
Okay. Let's see. Here's a question. Can you do the cost segregation on your own, or do you need someone that is licensed?
Okay, so there's no license that you need to do cost segregation work. There are some do-it-yourself cost segregation websites out there where you kind of got to make these decisions. I tell people, the bigger the project, the bigger the depreciation that you're going to get, the more likely you're going to need a specialist to get it done right. So I'm not going to tell you that your CPA can't do it, but what happens is the IRS, with these 87,000 auditors that are coming, they're going to be looking at depreciation projects, and they're going to be looking at cost seg studies, I think, in the future, especially those that are not done by an independent third-party firm that uses an engineering-based methodology. All the documentation is there. It's just like the IRS wants it. There's pictures, there's plans, there's experience in the people that do the study. All that is executive sleep. When your head hits the pillow, you don't want to have to worry about, did my CPA do that right, and am I going to have to give that $100,000 back? You really,
Yeah.
and here's what you're going to find. Whatever the tax professional or the depreciation specialist charges you, they're going to get so many more deductions, and it's going to be so much more secure and documented than what your tax pro will charge you. They may charge you the same thing or a little bit less, but they're going to get a lot less. I've seen this, in my 10 years, I've seen this over and over again. Hire a good quality firm. The good quality firms in our industry are some of the bigger ones that have multiple people,
Mhm.
and they're the people that have defended their studies. So a good quality firm is going to say, I'm going to stand up for these results. If there ever is an audit, and this isn't an audit trigger, but if there ever is an audit that you're caught up in and they have questions on this, I'm going to defend it no matter what. I'm going to represent this and show them how I did this. What happens in the industry is typically they will look to see, hey, this is independent third party people that do this for a living. We're familiar with this company. We know their work. I'm here for dollars. I'm not here to beat on this thing and try and get a nickel out of it. Let's go to the next item. Versus if your CPA did it, they're going to know he's never looked at a set of plans, probably didn't go there, didn't take any pictures. It's not well documented. They may challenge that one because they know that is probably not done to the standard that you would find with a big company. So I'll get off my soapbox here, but that's my professional opinion.
One thing I do want to say, as someone who has commissioned cost segregation studies repeatedly in many different contexts, is that when you hire somebody, they come in and they give you a draft report. You provide to them, the address and a lot of information about the property, and they give you an estimate of what they guess is going to, just a kind of a ballpark, like, here's what we're thinking, and this is how much the report will cost. And then of course, you have the ability to say, like, well, that's worth it to me, or that's, I wasn't going to get as much as I thought, or wow, this is going to make a big difference to me. So it's not like you have to pay the cost segregation expert, to talk to them on the phone. That's one thing that's great about this occupation, is that they will give you advice to a certain extent without you having to, pay them for that first conversation.
You're exactly right. And that's how we run ours as well, is if you'll simply share the type, building, in-service date, depreciable basis, and the address. I'm going to look at that building online. I'm going to see what type building it is. I'm going to get a good feel in our 20 years of history. Here's typically the percentages that we get out of that type of building, and give them an estimate to say, here's the cash flow you can expect
Mm-hmm.
at your tax rate. And, here's the cost to get that done. Does it make sense?
Yeah.
Talk about it.
Yeah. So it's very practical. It's a very good exercise to do. Okay, well, we are at time. I'm going to have you take a quick look at the questions. There's a few still out here. Some people still about real estate professional. Maybe we'll ask this question because a couple people have asked it in different ways, and then you can pick one more. So effectively, if somebody has rental units and they are managing one of those units as an Airbnb, does that qualify for them as a real estate professional?
Yeah, yes, it can. So are they spending 13 hours a week doing that? If you're running an Airbnb, you're spending a lot more than 13 hours a week managing that. Do you materially participate in that? You're the person doing the bookings. You're the person that's getting the cleaning crew there. You're in charge of getting the grass cut. You drive by and say, is everything looking good? Yes, that would probably qualify you if you're running an Airbnb or two. You're going to put in enough time, you're going to have the position, and you're going to be responsible for that. You're going to qualify. Now that takes all of that income to where you can apply those deductions not only against what you're making, but also against a spouse's income or other active things like capital gains that you might have and so forth. So yes, it opens up a world of possibilities. That's why we see so many people getting into the Airbnb rental game, because it gives them so much flexibility with these deductions.
Awesome. So why don't you go ahead and choose one more question in the Q&A box, and we'll call it a night.
Well, my apologies. I don't have the questions up here, but let me just wrap up with this. It's
great. Go ahead.
I'll wrap up with, I start off with the quote: the operative assumption today is that someone somewhere has better ideas, and the operative compulsion is to find that idea, learn it, and put it into action fast. So I would challenge you, to say, who's your depreciation specialist? Because you can see how complicated this is. You need someone that you can pick up, call, and say, hey, what about this? As you said, Anna, it doesn't cost anything to get an analysis on your building, up front, a preliminary analysis to say, here's what you're eligible for. Here's what you could have taken in the past and you didn't. Let's go ahead and get that corrected. Let me work with your CPA or tax professional to get this done for you, to make it easy for them So, you've got a lawyer, you've got a plumber, you've got a broker, all on speed dial. Add a depreciation specialist, and if we can earn a spot on the team, we appreciate the opportunity.
That's a great. I love that. Sounds great, David.
Yeah.
Well, thank you so much for being with us, David, and walking us through all that. I certainly learned a lot. I love learning about depreciation and cost seg and bonus depreciation and all of that. And thank you everybody for joining us. If you have any questions, you see his phone number and his email right there in front of you. So I think he's okay with you reaching out.
That's right. You don't have to remember a word of what I said. Just remember that phone number, and you've got someone that's going to answer your questions for years to come. Anna, thank you so much.
All right.
This is great, and I look forward to seeing some of your projects. I may have some money to put into real estate. So
there you go. Well, we've got some bonus depreciation just with your waiting with your name on it, David.
There you go. I'll get you a good deal on the cost seg study.
Awesome.
Thank you so much.
Thanks, everybody. Have a wonderful evening.
Okay.
Bye-bye.